As we roll into quarter three, this is the perfect time for this video. A full quarter three state of the market report talking about all aspects of the economy, including your financial risks and your financial opportunities. We will discuss inflation, debts, real estate, stocks, bonds, cryptos, and recession. Most importantly, I'll tell you what to do about it and where your opportunities lie. This isn't about making a really complex and heavy video. It's quite the opposite, actually. As you're going to see, I move pretty quickly. And the reason I have to talk about all different aspects of the economy is because they're all parts of the same machine.
Understand that nothing we say here is intended as personalized trading advice for you. On behalf of myself and the entire Peter Leeds team, we love you guys, we do this for you, and we do this because of you.
This is such a unique time in the global economy. There's more meaningful events happening right now, a lot more commotion going on than usual, and in all of this commotion, that's where all the opportunities come from. I often tell you that more millionaires were made in the Great Depression than any other time in human history. I think it's going to happen again, but you ask yourself, how did these people in the Depression become millionaires? Well, they did specific things. They bought assets for pennies on the dollar. They bought a different mix of stocks in a depression, as you'll see, or a recession even. There's certain stocks that will do very poorly, while there's other stocks that will do incredibly well. When they bought into things, they acted at a capitulation point. And as I explain in my book, Upthinking, Chapter 4, it's all about capitulation. Spotting capitulation, how do you know if it's a real capitulation? And I gave examples through history of different times where there was a capitulation point and it led to significant gains. And it's not about picking the bottom. It's a lot easier to find the capitulation point and get in anywhere around there, and that's going to be the best thing. As I say in Upthinking, which is available only through peterleeds.com, what I say in Upthinking is that the best time to buy anything is always at a capitulation point. Some people owned some gold, and gold increased in price. Not only did it increase in price, but at the same time, a lot of stocks absolutely cratered. So comparatively, gold did incredibly well. And we're going to get into this a little bit later in the video about what happens with gold in a depression, or even in a recession, times of inflation, times of deflation. And during the Depression, people became millionaires because they adapted their lifestyle or they changed their business. Maybe they had an expensive steakhouse and they changed that to a pasta restaurant. They adjusted, they adapted. In some cases, they might have downsized their home. They might have moved to a whole other area. But the big one was that people would buy a business for pennies on the dollar. There's a lot of assets that you think you can't afford that will become affordable, and it would be a really good idea for you to acquire them. I'm talking about businesses, I'm talking about buildings. And you might say, Peter, I'm not going to buy a building, but I'm talking about small items too, lower items, a car, golf clubs. Just go on Kijiji. There's going to be a lot of Rolex watches selling for much less than they're worth. So basically all the things I talk about with you guys on these videos. Now understand, people are going to be rushing across the raft back from one side to the other. They're going to be slipping in the water. They're going to be bumping into each other, knocking other people off the raft. And in all this commotion, there's going to be tremendous and numerous opportunities for you to better your situation, enrich yourself, and take care of the people that you care about. So let's start with what you know to be true. Debts across all levels are way too extreme. And they are only getting greater and greater and greater. There's no financial responsibility where we're paying down debt. I'm talking about you personally. I'm talking about corporations. I'm talking about the states. I'm talking about the entire country itself. The government has $30.4 trillion in debt. But here's the important thing. It was $23.2 trillion in quarter one of 2020. That was only 2.5 years ago. So in other words, in 2.5 years, a 31% increase. But now, since I even got those stats, the number's actually greater by that point. The federal debt right now is $31.5 trillion. And this is from Truth in Accounting, and there's a lot of good stats here I'm going to give you. But it's like I always say, the first place I go when I look into a company is the quarterly balance sheet. I see how much money do they own versus how much do they owe. The federal government has assets, what they own, of $5.95 trillion. But then let's talk about, what does the federal government owe? What are their liabilities? Unfunded Medicare promises. And notice that word promises. I love that Truth in Accounting does that because it is a promise. They promise to pay that money. That's how they get you to pay into it. There's huge pools of unfunded money that is owed to American citizens, which is not there. I'll let you guys figure out what you think happens with that. Unfunded Medicare promises, it's over $55 trillion. Unfunded Social Security promises, it's over $41 trillion. Publicly held debt, $21 trillion. Pension and retiree healthcare liabilities, $9.4 trillion. So if you add all that up, that's what they owe of $129 trillion. And this is also from Truth in Accounting. The public holds over $22 trillion of national debt. Foreign governments hold a large portion of the public debt, while the rest is owned by U.S. banks and investors, the Federal Reserve, state and local governments, mutual funds, pension funds, insurance companies, and holders of savings bonds. Do you remember that recent video I did about the retirement crisis alert? What's going on is that there's not enough money there, and what's happening is a lot of the states are saying, well, we can't give you your pension, so we'll give you less than you thought. They're asking for more contributions. They're saying you got to pay more into it, and they're basing everything on a 6 or 7 or 8% gain in stocks. And so what happens when stocks go the other way? I was talking about that one number, that 6%, that 8% number that broke. And what they're doing is that they're putting the losses on the stock market onto the investors, or the ones who are owed the pension. They're saying, sorry, the stocks went down, so you get less pension. Hey, you sign on for that. That's the way they set it up. And at the same time, they're also cutting services because they can't afford it. A lot of these states and municipalities are cutting services because the stock market came down. That's what the point of that video was about. That's what the result is going to be. And all the losses, I'll say this again because it's very important. There's a time where they switched it. All the losses now are on the shoulders of the people who are expecting the pensions. And you've heard about muni bonds. That's kind of like a municipality, like a city. They have bonds that they issue to raise money, and they're supposed to pay back the principal with some interest. It's over $4 trillion in muni bonds that's out there. One of the major risks associated with municipal bonds is the possibility that short-term yields will rise. You know that rates are going up, and so that risk has come to fruition. This means other bonds coming onto the market will pay a higher rate to bond owners, and your bond will be seen as less valuable. This can cause the price of your bond to drop. So when they raise rates, bonds go down. So if you have municipal bonds, if you have any kind of bonds, it's going to hurt you every time they raise rates. And this is according to Wells Fargo. Corporations have $12 trillion in corporate debt, and that is a record. And this is according to debt.org. Individuals have an average of $90,460 in terms of adding up their credit card liabilities, their mortgages, their loans, their auto financing, their student debt, lines of credit. And that was $15.6 trillion in 2021, according to CNBC. And interestingly, a big part of that debt increase has been because mortgages have increased in size. The value of homes has increased in size. People are buying more expensive houses. So a lot of that debt is because the real estate market was doing so well, it's performing so strongly. So an interesting thing that will be a good thing, I know I talk about a lot of negative things because there's so many of them to talk about. One of the good things is that as real estate starts coming down, as it will, as it's begun to, then some of that debt level, some of those debt loads will become generally organically smaller. A large chunk of the debt load increase came from mortgages, which saw balances rise by $890 billion for the year. And hey, before I forget, even though I've already forgot, so I'm going to say it now, in the comments below this video, tell me the largest major city that's near you, so that people from all over the world can see exactly where you are, where you're from. And you know we've got a big deficit spending problem where the federal government in 2021, they brought in $4 trillion in revenue, mostly from taxation. And then there's a bunch of costs, which came out to, or added up to, $6.8 trillion. Which means that we had a $2.8 trillion shortfall, which adds to the national debt. And the operational deficit is just ongoing. It's every quarter. We're just spending more money than we bring in. That is fiscal irresponsibility, but that's just the way it is. And add to this that we have an ongoing trade imbalance where we buy more things from other countries than we sell to them. In the most recent month that was reported in May, we had a trade imbalance of $85.5 billion. The good news being that that is a 5-month low, so great. It's kind of like knowing an alcoholic who drinks 20 beers a day, and then they say, you know what, I'm only going to drink 15 beers a day. And then they want kudos for that. That, unfortunately, is a situation we're in with the trade imbalance for our United States of America. And you may have heard that the economy is so strong. But why are they saying this when the economy is so weak? From the president, from the representatives of the Federal Reserve, and they're always telling you the economy is so strong. They're doing that because of the low unemployment rate. That's the thing that they're hanging their hat on. And the unemployment rate is very low right now. It's about 3.5%. And I always say that it can't go much, much lower. It's not healthy for an economy. And for example, my buddy Cameron, we were just here with me and a couple other buddies, and we're talking about he has a business that he runs, and they've got about 20, 25 employees, something like that. And he says that he's hiring people and they just change their minds or they ask for more. He can't find employees. And a lot of businesses are suffering the same situation. They can't get the employees. And are you noticing that you can't get good service anymore? If you want to see good customer service, call Tammy here at this office, and that's how you have good customer service. That's somebody who's looking out for you. And I know I'm jaded. I was just in New York. The customer service there is absolutely gone. It doesn't exist. But it's a problem over all the economy right now. When there's such low unemployment, the quality of service you get is less. People who are looking for a job are more demanding. They're expecting more and getting more. And to keep the employees you have or to attract new talent, it costs business owners a ton. So it's actually a hidden tax on businesses when the unemployment rate is so low. But we're going to talk about that a lot in this video. And just to remind you, the reason I'm going to talk about all different aspects of the economy is because it's all part of one machine, and so that you can get a better idea about where everything's going when you look at every aspect of it. And as I told you, the cryptocurrency industry is contracting right now. This is from Blockworks. Coinbase cut 1,180 staff, which is about 18% of their team, and rescinded job offers. BlockFi laid off a fifth of its workforce. Gemini let go an estimated 100 employees. Singapore-based Crypto.com reduced staff by 5%. That's about 260 people. So that's only a small window of part of the economy. But then there's also layoffs in the financial sector too. The headcount at JP Morgan's investment bank, Goldman Sachs, and Morgan Stanley all jumped by 13%, 17%, and 26% respectively in the past 2 years amid a hiring binge. Meanwhile, capital markets revenue has fallen off a cliff, and they've come out and said that they are reducing their workforce. They've overextended, and now they've got to back it off a little bit. And here's some stats from Intelligence. Tesla is laying off another 200 employees. Tesla CEO Elon Musk has a super bad feeling about the economy and plans to cut about 10% of salaried staff. And the company has about 100,000 employees as of 2021. So 10% is 10,000 employees. White Hat Jr. is laying off 300 employees. Spotify is slowing hiring by 25%. That's the latest signal that companies across tech, many of which grew significantly over the early stages of the pandemic, are cutting back on staff growth as economic uncertainty looms. Netflix is laying off 300 more employees, and I'm going to give you a broad sample of different types of industry groups, different types of businesses in different industries to show you that the layoffs are going to be broadly based. Vault is laying off 30% of its employees, and they're in the cryptocurrency industry. Vault has laid off around 30% of its workforce as crypto prices have crashed over the recent weeks, along with the taxation regime and the resultant downturn in trade volumes. With the price crashing, there's a lot less activity. A lot of these cryptocurrency trading businesses are suffering a bit. Coinbase is laying off 1,100 employees. OneTrust is laying off 950 employees. That's a privacy and security business. FarEye is a software as a service business, and they're laying off 250. CVS is laying off 208. TomTom's laying off 500. Their IT services and consulting. Starts Tech is laying off 472, and that's in the fintech space. And Laceworks is laying off 300 employees. They are a cloud security company. So I'm just giving you a broad range to show you that there are layoffs across all aspects of the economy right now. And with gold prices taking a hit, some commodity prices coming down, there's going to be less mining, hiring. Manufacturing still is getting better, and it is still taking jobs away. Things that people do are no longer being done by humans. That will always continue. There will eventually be robotic bartenders and robotic fast food servers and robotic trucks. It's all coming. Anything that can save that much money for businesses will happen, even if it costs a whole bunch of employees. And retail's been getting decimated, so there's been firings there or fewer hirings. And then you're talking about the service sector. As we go into a recession, there's going to be a lot less people going to, for example, a restaurant. So there's fewer servers. And that's the one that really is a temporary kind of employment thing. Do you know that the turnover rate of McDonald's or a typical fast food place is more than 1.0? So the average time someone works at McDonald's is less than 1 year. So you'll see these times where all these hirings go into the service sector, and then that's where all the firings happen as well. It's like an accordion. So you're going to see a lot more unemployed people from the service sector. And quickly, just before I get into how gold does in a recession, and inventory gluts, and personal delinquencies, it's time. I've been talking about raising an army, and now it is the time. What you can do, you'll notice in the bottom right below this video and all my videos now, it says join there. What are you joining? You're joining the Peter Leeds Army. You're showing that you're a supporter of the Peter Leeds channel. And what you get, among other things, you'll get called out more, I'll answer your questions, and every comment you make, there's going to be a Peter Leeds icon beside your comment, a badge, and that's your rank in my army. And that badge will change color the longer you're a supporter. As well, we've got a bunch of custom emoticons that we made specifically for supporters of the Peter Leeds YouTube channel. It means you get more videos, more in-depth videos, and you get your comments called out more. It's going to be an incredible thing. I've never asked you guys for money. I've never advertised before. So I really want to build an army so that we can do and accomplish some really cool stuff. And check it out. The first person who jumps in and is a supporter of the channel makes a comment. That will be literally the first instance of the Peter Leeds badge showing up beneath a comment beneath one of my videos. So check it out. If you rush, you can do it just by clicking the button, a couple of clicks, make a comment. There's your Peter Leeds icon, and it'll change color over time. And to get back on track here, you know that we're going to have a recession. Is it going to be significant? When's it going to start? Those are the debate points. But in my opinion, and it's kind of been clearly obvious to me for a while now that we're going to have a recession. That's why I was talking about it before anybody else was talking about it. And now some people are saying it's going to be a soft landing. Other people are saying it's going to be horrible. We're all going to find out together. But what does it mean? It means that there's going to be fewer people with excess money to spend. People are getting hurt right now by inflation, the reverse wealth effect of things like cryptocurrencies and stocks coming down, and soon house prices coming down. The wealth effect has more of a result from the value of your home. A home is typically the most expensive thing that anyone buys. You've got a wealth effect with a home more than anything. So the wealth effect is reversing, and cryptos and stocks are now soon to be home ownership. Plus, you've got fuel costs being so great, plus all the messaging you're seeing. You turn on the news and it's all about how you don't have enough money to pay for gas, and how inflation is just eating up all of the expendable money people have. But we're going to get into a little bit about how some inflation points are really coming down significantly in just a minute. But one of the things that's going to happen is that there will be a further slowing of the velocity of money. And a lot of people talk about velocity of money, but they don't really understand it. You can tell by the way they say it. What the velocity of money is, it's an output. It's a result. It's telling you something that's already happened in the past. You can't control the velocity of money. It's just telling you what has happened in the past. How many times the dollar was used as it cycled through the economy over a given period of time. But a slower velocity of money, less activity going on, is also going to hit corporations that sell things. But I promise I wanted to tell you a little bit about personal delinquencies. And here's the thing. People think that I'm so negative, whatever. I'm pulling out this because it's actually really strong. It's really good. The personal delinquency rate in quarter one of 2022 was 1.24%. That's very strong, very low. Compare that to 7.5% in quarter one of 2020. But check this out. 2006, the personal delinquency rate was 1.45. And then you have the recession and the delinquency rate cranks higher. And then you get through the recession and it keeps going a little bit higher, and then it comes down. Every recession, the delinquencies ramp up and then they come down. So are we going to have a recession? Yes. Is that going to cause the delinquency rate to rise? Yes. From this very low, very strong base of just over 1%. But with a recession inbound and the way it's going to affect everything and all the follow-on effects, that's going to hit corporations. It'll be with a lag, but there will eventually be poor results for the corporations. And what's the first thing a corporation does when they're suffering a little bit, when they're bringing in less money? They typically will lower the headcount of the company. They'll typically fire people. And when you fire someone, they have less money to spend. And that'll make things worse in terms of the ways that the recession is affecting the overall economy. And what corporations do when they can't right the ship by laying people off, if the things are worse than they expected, even beyond that, what do they do after that? They either default on the bond payments they have, or they go bankrupt. And a lot of times the company goes bankrupt and they liquidate all of their inventory. But there's big supply gluts from a lot of operational companies that are not going bankrupt right now. They've overstacked their inventories, especially after everything we've been going through over the last few years. They reacted to all the consumer demand and they overstacked their inventories, and now they're realizing that no one's buying anything and they've got to start getting rid of some of this stuff. I talked about this in the recent video. Listen to some of these headlines I was looking at. From Talk Business and Politics, retailers grapple with widespread inventory glut in recent quarter. Modern Retail says retail's inventory glut means big business for liquidators, and put a pin in that for later of some of the types of companies you want to maybe invest in. And this is from Eckstein, Summers, and Armbruster and Company. The inventory glut of 2022. So what does this all add up to? What does this mean? Especially with the recession, plus everything that's happened over the last few years of the changes in spending habits of the companies themselves, how they're loading up on inventory, that all adds up to what is going to be a lot of bargains. A lot of companies will compete with each other to get rid of their excess inventory, and the way they do that is to offer it for lower prices. And maybe you think I'm just trying to depress you with all this negative talk. I don't need to be doing this, and I want you to prepare for what is going to come. And I'm sorry that we're finding ourselves in such a tough spot. But putting your head in the sand and not paying attention to it is not the solution. It won't be better for you, I promise you. People are going to get completely blindsided. But if you know how to land on your feet and what moves to make to better enrich your wealth and to better help the ones that you care about and to better come out the other side of this, and that's what you need to do. And if you hear me out, you're going to know a lot better how to prevail and thrive in what's to come. And I know that you know other people who would also benefit from this message. I am asking you to send this video to them. And you're hearing inflation is going higher, inflation is going higher, prices are going up. Yeah, eventually I believe they will. But I also am one of the people saying that inflation is actually going to come down before it goes higher, especially if we go into a really serious recession. But listen to some of these stats. These blew my mind when I was looking at them yesterday. In the last month, wheat is down 21%, oat down 27%, canola oil, canola is down 16%, corn, which is in everything, is down 22%, gasoline's down 15%, and the price of gas in a lot of places now is under $4 a gallon, which is an improvement. Soybeans are down 12%, and gold is down 7%. And copper, which is in everything, is down over 16% in the last month. Iron ore is down 24%, cotton's down 30%, cobalt's down 23%. Potatoes are up 11.11% in the last month. Tin is down 22%. So what does this all mean? The components that come together to make any kind of product are going to be costing less for the manufacturers, and it will therefore be less likely that they're going to be passing costs on to you. Things are getting less expensive. And you guys know I talk about this delusional curtain that has to be pulled back, and it's not back all the way yet. But some of the stocks have come down significantly. When you're told that they're going to go to new highs this year, they're actually going down pretty significantly. At its peak, the S&P was at 479. Now it's at 381. These numbers will have changed by the hour, but it's down about 25%. The NASDAQ, which was at 16,212 at the peak, is now at 11,360, down 42%. Dow Jones Industrial Average from 36,952 to 31,072. That's a decline of 18%. So stocks were over their skis, the valuations were over the moon, and they're coming back to a more realistic level of whereabout I expect them to be. They're not there yet, and we'll talk about that just coming up in a second. But the detachment between stocks and the economy is extreme. And a big part of that is because these artificial influences, like the plunge protection team, quantitative easing, again and again and again, bond buying, the Federal Reserve buying specific stocks. And as you know, these artificial influences, anything artificial is temporary. So they're holding up the market for now, but eventually they can't be any longer. And that's when you're going to really feel the pain. Now I want to talk to you a little bit about investor sentiment. This is from the American Association of Individual Investors. For the week ended July 13th, 27% of people have a bullish outlook and 46.5% have a bearish outlook. The thing about investor sentiment, it's a contrarian indicator. So the more people who think there's going to be a stock market crash, that's more likely to be the time where you want to buy. Because people act on their beliefs. If everyone thinks the stock market's going to crash, they will have sold, they won't be buying in, and so that makes valuations of stocks really attractive. What you want to do is buy when everybody's expecting stocks to go lower. And the historical average for people who are bullish is 38%, and now it's down to just about 27%. And in terms of how many are bearish on a historical average of 30.5%, it's a lot more than that at 46.5%. The more people that believe or have a bearish outlook, the more likely we're closer to a stock market trough or bottom. A lot of people are expecting negative things for the stock market, and that is leading into a little bit of strength in the medium term, the next few months, with the stock market. But overall, while we may have anything happen in a shorter term time frame, months or quarters, I don't think that we're done yet on the downside. I think that we have to hit a pain point. You have to get to a capitulation point, and that will be the single best time to buy anything ever. When things capitulate, you could buy stocks in any of the companies that you want. Apple, IBM, Bombardier, Cracker Barrel, at pennies on the dollar. That's the time to get involved with stocks. There will be a pain point for stocks where everyone's just suffering from stocks going down. And that's also going to line up with a capitulation point, which I discuss in depth in my book, Upthinking. Capitulation is the single best time to buy anything. And that's why you also want to subscribe, because I'm going to tell you when I see capitulation points, and that's when you got to act. That's when you got to load up the truck. And don't forget, I'm going to talk to you about what happens to gold in times of recession, depression, inflation, deflation in just a second. But first, I'm going to talk about real estate. And this is kind of a demonstration of the value of being ahead of the game or being upstream a bit, where no one knew that real estate was going to come down. And I started telling you, real estate's coming down. So maybe you could have acted on that. You could have not bought a house or sold the house you had and downsized or rented or whatever. I mean, there's things that in your situation you can decide what to do. But there's a value in knowing ahead of time that real estate's going to come down when no one else is talking about it, except for me, and everybody who watches these videos knew about it. Now that real estate prices have begun sliding and all these factors that are going to be weights against the value of real estate are all adding up and piling up, we've seen home builder sentiment absolutely plunging in July as buyers pulled back, and that's according to CNBC. This was the largest single month drop ever, except for April 2020. What happened in April 2020? Yeah, that thing. They go on to say the risks for real estate will be rising interest rates, and as you know, interest rates will rise again soon this month. A recession is another risk for real estate, and as you know, a recession is about to happen. And there's a lot of layoffs coming, and when people get laid off, it's harder to afford a house. And even people's lifestyles are changing. We saw this when everyone moved out of the cities to work from home out in the countryside. And we've seen people changing their lifestyle. They're leaving the office and working from home now. And that's going to change real estate prices in some markets. So a lot of things against real estate that are all adding up. And it's something that was coming for a while now. And I've been talking about it for a while. And now it's playing out. And I also want to mention something quickly about bonds, because I don't want to leave them out. And I wanted to say something about bonds. When you go to CNBC, for example, and you look at bond prices and it's a bunch of red and negative arrows, that's a good thing. That means that the yields are coming down. The value of the bond is therefore increasing. And what's not great for bonds is when there's rising rates. Interest rates go up, that is not good for bonds. And whenever I talk about bonds, it reminds me because I just the other day released my entire personal portfolio. All the stocks that I hold, all the investments I own, precious metals, different options, different stocks. But again, never bonds. I do not invest in bonds. I don't think that that's a good way to make a meaningful difference in your life, even if they do well. But people think bonds are safety. They're not safety. You can see over a 40-year bull market when they reverse start coming back down. Now people are sitting there looking at their portfolio statements saying, but I thought that was safe, and they've lost a ton of money on bonds. Now I want to get into precious metals, one of the most unloved investments I have ever seen. I want to talk about an article I read in Small Caps. This is from Australia, and the article is called What History Teaches Us About Gold in Economic Crises. And it's written by Robin Bromby. During the 6 years of the Great Depression, and pay attention to that it was 6 years long, Homestake Mining paid out $128 per share in dividends. If you bought Homestake Mining shares from your Wall Street broker in October 1929, which was the big stock market crash, which they were in the crash for months before they realized the crash had begun. So don't think that a stock market crash happens in a week or a short time frame. It takes months and months. If you bought Homestake Mining shares from your Wall Street broker in October 1929, they cost $80. But by 1935, Homestake stock was worth $495 per share. And I know this is just one example, and it's a cherry-picked example, but there's lots of stocks that did this, especially in the mining field. You'll notice that they paid more in dividends, $128, than the actual value of the stock, which is $80. That was the capitulation point right there. And then a few years later, that same stock, in addition to all the dividends, is worth $495 per share. What happened is that gold went up a good amount, nothing extreme, but then the profit margins of the mining companies ballooned. So Homestake Mining increased realistically in value. It wasn't just a bounce from a low, it was an actual overall fundamental improvement. And you're going to see a ton of fundamental improvements and a ton of increasing prices if you spot the capitulation point, which is very likely to be coming up kind of soon. And if it doesn't happen soon, it'll happen thereafter, but it will show up in cryptocurrencies and real estate and stocks. There will be different capitulation points of each, and that's when you want to buy everything. If you're buying a house, do it at a capitulation point. Crypto, stocks, it's all the same thing. So in the Great Depression, some people bought stocks at the capitulation point, and that's one of the reasons that a lot of people became millionaires. But let's talk about gold as I promised. Remember that gold was fixed in price because the American dollar was backed by gold. But in 1929, price of gold $20.69. Now pay attention to this. 2 years later, 1931, gold was trading at $17.06 per ounce. And then by 1934, 3 years later, gold was at $34.69. And remember, these are all set prices by the government. But the point is, look what happened between 1931 and 1934. From $17 to $34.69, that's an increase of 100% in the price of gold. What I want to show you there is that gold was undervalued. It got even more undervalued, and then it just bounced and went a lot higher in a short time frame. Short being a few years. But gold is not ever changing price. Gold is gold is gold is gold. Gold is equal to 1. And then it's about how many dollars of whatever currency it takes to get that asset. So keep gold in mind as I talk about the US dollar in this next section. This is from Money Watch. Euro is worth less than the dollar for the first time in 20 years. So what do you think is going to happen to the US dollar when certain things play out as they are right now? There are major power shifts right now worldwide. And in any kind of shift, there's a lot of opportunity there and a lot of risk. In this situation, there's more risk, but the opportunities are going to be incredible. This is from Indie TV Profit. China's central bank has signed an agreement with the Switzerland-based Bank for International Settlements as part of Beijing's plans to establish a yuan pooling scheme starting with Indonesia, Malaysia, Hong Kong, Singapore, and Chile to counter the dominance of the US dollar. And here's another headline. I apologize that I don't have the source. Are China, Russia, Iran, and maybe even India actively creating their own reserve currency? There's 8 billion people on the earth. In China, there's 1.4 billion. In India, there's 1.4 billion. India is about to overtake China in terms of population. But if you think about it, that represents 35% of the global population. 1 out of every 3 people lives in either India or China. 2 countries, but there's more. The BRICS countries, Brazil, Russia, India, China, and South Africa, plan to develop a new global reserve currency based on a basket of their currencies. And here's a comment from Putin. Putin said trade between the Russian Federation and the BRICS countries increased by 38% to reach 45 billion in the first 3 months of 2022. So you can see there's all these pushes away from the reserve currency, and it's from a major base. Almost everybody's using the US dollar. It can only come down percentage-wise from here. And I'm not saying it's going to happen anytime soon. I'm just saying that as it happens, it'll happen a little bit more and more. And the more it happens, the less demand there will be from other countries for the US dollar. Many of these countries hold a lot of US dollars, and they'll be releasing these into the wild. They might say, well, we don't need as many US dollars anymore, so why don't we buy a bunch of Bombardier jets or buy some other currency with it, and some of those dollars will come back to America, and that's going to cause inflation to go higher. It's also going to cause the purchasing power of the dollar to decline. According to the IMF, 60% of known central bank reserves are in the US dollar. And in terms of use in global trade, that's 40% of all transactions. But here's where it starts. The share of the US dollar reserves held by central banks fell to 59%, its lowest level in 25 years. Some analysts say this partly reflects the declining role of the US dollar in the global economy. Some expect the US dollar's share of global reserves will continue to fall. And add to all of that Saudi Arabia is changing the petrodollar relationship to a certain degree. This is according to the Wall Street Journal. Saudi Arabia considers accepting yuan instead of dollars for Chinese oil sales. They're using it as a political weapon, actually. Talks between Riyadh and Beijing have accelerated as Saudi unhappiness grows with Washington. Prince Turki Al Faisal said Biden was coming in a much diminished president, compared with when he was inaugurated in January 2021. The relationships between America and Saudi Arabia are changing. It's a very important relationship, but a lot of our lifestyle is based on the fact that American dollar is the petrodollar. It's the reserve currency as well. Those are 2 different things, but they're cousins, okay? So they sort of go together, but not technically, but sort of. And don't forget, I'm going to tell you action steps about things you can do. No fluff there, stuff you can actually do, actionable steps to preserve your wealth, build your wealth, and take care of the people that you care about. So with everything that's going on with the petrodollar and the reserve currency status, those will be some negative tides for the dollar. Nothing soon, but it's all happening now for the first time ever. And at the same time, we have clearly and obviously to the world shown in America that we have totally taken advantage of our position, and we've created more money in a very short window of time over the last few years than anything in the past. All of these things are going to add up to put a lot of pressure on the dollar. And I'm not just telling you stuff to get you all upset. I'm telling you, based on everything that we're dealing with, what's going to happen so you can land on your feet. You know that the debt levels of corporations, municipalities, government, everybody's too great. And you know that interest rates are going to rise even more. So what happens then? As interest rates rise, you're going to start to see the first defaults. It'll start with corporations, but it's going to bleed over to a lot of pension funds from municipalities, the state pension funds, the city pension funds, even some corporate pension funds. As you know, that they have to have 6 or 8% gains every year just to pay the money that they owe. There was even a pension clawback a few years back, but it was luckily an isolated incident. But let me give you a summary of what all this means just before I tell you action steps you can take, what you could do right now to land at a better position. Look at the geography of America. We've got 2 coasts, tons of resources in the ground, plenty of room to grow food and farm cattle. And most importantly, there are not a lot of other countries on our borders that are going to invade and do things that you see a lot of what's going on in Europe, even in Asia. There's sometimes an interruption in the development of a nation. Look at what's going on in Ukraine right now. Look at just about every country in Europe. They've had people driving over their borders and bombing things and attacking them for hundreds and hundreds of years. And who's going to invade the United States? What, Canada again? Maybe in the old days with the help of the British and the French, but not anytime soon. That's why the White House is the White House. It was burned down by the Canadians. But look, the reserve currency of the US dollar has kept the dollar in demand worldwide. The percentage of how much the US dollar is being used in global commerce is slightly declining, but could accelerate even faster. As demand for the US dollar declines from a very tall ladder, there will be fewer countries that are going to hold US dollars, and a lot of those dollars will find their way into the wild and find their way back to our shores, diminishing the value, purchasing power of the US dollar on our shores, stoking inflation on our shores. And at the same time, retirees are being forced to withdraw some of the money they've invested in the stock market. I know taxes are different for everybody, but when you're a baby boomer, they say you can invest for your retirement, and then as you get older, they, just like my father, they force you to take a certain amount of money out of your retirement savings so they can get their tax one way or another. And you can take the money out and invest it back in the same stocks, but is that likely? Most likely, baby boomers will take money out of stocks and invest it in living their lives. Buy stuff for their grandkids. And you know people are fully leveraged. If you can borrow $100,000 to your stockbroker, you borrow the full $100,000. This is from Forbes. For the first time in history, the U.S. leveraged finance market, a combination of leveraged loans and high-yield bonds, which means that they're below investment grade, is over $3 trillion. So they're a bit riskier. That amount, for the first time in history, is over $3 trillion. Leveraged loans have grown almost 130% since the financial crisis, more than twice the rate of the gross domestic product, which increased 57% in that same time period. Now interest rates have increased meaningfully for the first time in many, many years, and they're going to increase even further. And what do increased interest rates do? What is the point of increasing interest rates? They say to combat inflation. But what is it really doing? It's hurting the economy. The Federal Reserve says, are you worried the economy is running too hot? Don't worry, we'll punish it. We'll make it harder to run a business, harder to pay for debts you have, harder to pay your credit card bills, harder to pay your auto loan. Now think about it. Just ignore inflation completely for a second. The Federal Reserve thinks the economy is strong and it's very, very weak. And they're saying, don't worry, we're going to hurt the economy. And they'll be absolutely successful in that. Your debt paying is going to increase. Corporations' debt paying is going to increase. The government tries to get inflation so that it makes it easier to pay off the debts that they can't afford to pay off. And next we get a recession and all the follow-on effects from that. Subsequent to that, there's going to be overreaction number 1 and maybe 2. Overreaction being the powers that be coming over the top and saying, don't worry everyone, you're in a recession, the economy's doing bad, now we admit that. And what we'll do is we'll print so much new money. And we'll give it a whole bunch of new money, and that'll push stock prices higher, that'll make housing prices increase, that'll even help cryptocurrencies to a certain degree. But that's the mistake. That's what got us in the situation in the first place. So they're going to come over the top. And if that doesn't do it, they'll go, okay, the problem was we didn't do enough. They'll do even more. And this will be astronomically greater than all the quantitative easings leading up to this point. But when they do that, either the first time or possibly the second time, the overreaction wasn't enough, so they overreact even more. As they do that, that is when we could get into some serious hyperinflation. And what is hyperinflation? That's products increasing by 50% per month. With all these moving parts, there's a lot of opportunity. You can preserve your wealth, enrich yourself, and help the people you care about by making the right moves now. And just before we get into the actual action steps, no fluff there, just things you can do. Before we get into that, don't forget, you can do it right now while I'm talking. Tell me what major city are you closest to in the comments below this video. So number 1, do not be afraid to act. This is for real. You're not just watching this for entertainment here. You're actually trying to get into a better place as we go through a very difficult situation. And I want every single one of you to buy a copy of Penny Stocks for Dummies Edition 3. I do not make a penny if you buy Edition 3, okay? So I'm not selling you anything here. And what I want you to do is go to the section 4, part 4, the new part, about 40 pages I added. It's all about getting your mind right in investing. That'll make more difference than anything you read on an article, any decision you make. Getting your mind right is so important. That's what the entire new section of Penny Stocks for Dummies is all about. And that book is one of the single best financial books ever written. And you can see for yourself by reading the comments on Amazon about how people felt about the book and what they thought after they read it. You got to change the mix of stocks you're going to invest in right now. You want to get away from the speculative stuff, the technology stuff. You want to be in defensive names like utilities or stocks that do better during recession, companies that help other people and other companies save money. Also lower end things like McDonald's, dollar stores. And I told you earlier about putting a pin in it. That's about the liquidation stores. They're going to do very well. They're going to have lots of products to liquidate as we go forward because of the inventory gluts. And with gold prices, whether you believe there's going to be inflation or deflation, and big periods and historical periods of either of those, gold has done well, especially gold mining stocks. Not exploration companies, but productive companies, companies that are actually pulling gold out of the ground and selling it. They've done very well because the price of gold increases a bit, their profit margin increase even more than that, and gold mining companies tend to perform very well, just like the example I gave you in this video about that stock, Homestake Mining from 1929. You want to make sure you spot the capitulation points, as I described in Upthinking. You also want to make a strike list of assets, things that you want to buy. That includes stocks. That includes certain cryptocurrencies. When there's capitulation, you should act immediately. You should be ready to act before capitulation happens, which means start getting ready now. And then when you have a capitulation point, you take whatever you can bring to bear to invest in that thing, especially if it's unloved, and it definitely will be if it's a capitulation point. Nobody wants it. They're throwing the baby out with the bathwater. That's when you swoop in. So make sure you have a strike list of what you're going to buy. Even if it's big time stocks like ExxonMobil or Harley Davidson, and you want to buy those shares, you do it when stocks capitulate. That will be the single most rewarding investment you ever make in your entire life. And a big part of what we do is we try and find stocks that are attainable, but they're just getting started. They're under $5 a share. These are what we are specialists in. And I'm going to start talking to you guys about some of the kinds of stocks we pick in an upcoming video. That's why you got to subscribe to the channel. And if you have a business, you want to adjust it. Or if you work at a business, you want to think about it. Are you working at a high-end steakhouse? Are you running a high-end steakhouse? That won't perform very well. It won't work out very well for you at a time when there's a recession and no one's spending any money. Adjust the type of business you're running for the times. And for sure, something that everybody can do if you don't have a penny to your name. Educate yourself. Read a book if you want. Watch some YouTube videos. That's how most people do it now. There's no excuse for you. You have the entire culmination of all human knowledge at your fingertips as long as you have Wi-Fi. So make sure you follow several people who know what they're talking about. And I really hope that includes me. I really want to do a good job for you guys. And I'm not doing this to try and sell you books and not trying to sell you things. If you buy something, that's on you. And help spread the message, build your network by sharing this video with 4 other people. I'm asking you to do that, please. And one other thing you can do is join the Peter Leeds Army. There's a join button in the bottom right-hand corner beneath this video. Click on that. I encourage you all to take a look around and see what you get. You'll get a small Peter Leeds badge beside every comment you make, and we'll know how long you've been a supporter by the icon or the badge changing color over time. As long as you're a supporter and you ask a question, if I see that badge there, maybe I'm more likely to address your comment and answer it so that you can learn what to do to land on your feet, the best stuff that matters to you directly. And as this big machine that is the economy keeps adjusting over time, we're going to keep giving you the message you need at the time when you need it.